Have you ever wondered how money is created? It's not just about printing notes or minting coins. It's a fascinating process that touches on economics, technology, and even philosophy. Money creation is a fundamental aspect of our economy, a process that transcends the physical and ventures into the digital realm. Reports suggest that there is approximately $37.5 trillion worth of money in various forms in the world. But how is this money created? Where did it come from? Stay tuned to find out. Money hasn't always been the paper and coins we know today. In the beginning, there was bartering. This was a simple exchange of goods or services where a cow could be traded for a bushel of grain or a day's labor for a warm meal. But the system had its limitations. It relied on a mutual need, a coincidence of wants, which was not always possible. As societies evolved, so did the forms of money. Precious metals like gold and silver became a popular choice due to their rarity and durability. They were universally accepted and could be divided into smaller parts. Eventually, these metals were minted into coins, a more convenient form of money. With the advent of paper currency, banks started to play a crucial role in facilitating transactions. They could issue notes that represented a certain amount of gold or silver held in their vaults. But in today's digital age, most money isn't physical at all. In fact, only about 3% of money is physical. The rest is digital. It might be surprising, but the majority of the money in the world isn't coins or banknotes, those tangible bills you carry in your wallet. Instead, it's numbers on a screen, a series of zeros and ones that we call digital money. You see, when you check your bank balance online, you're not looking at a pile of cash stored somewhere in a vault. You're looking at a digital representation of money that the bank owes you. So how do banks create this digital money? Let's delve into that. Banks create money not by printing new banknotes, but by making loans. When a bank gives out a loan, it doesn't take that money from someone else's savings. Instead, it creates new money. This might sound like magic, but it's actually a standard practice known as fractional reserve banking. Let's say, for instance, someone deposits £100 into a bank. The bank is required to keep a fraction of that deposit, say 10%, as a reserve. The remaining £90 can be loaned out to other customers. Now, if that £90 is deposited back into the bank by another customer, the bank can loan out £81 and so on. This cycle can continue indefinitely, and with each new loan, the bank is essentially creating new money. This might raise some eyebrows. How can banks just create money out of thin air? Well, it's important to remember that this money isn't wealth. It's debt. Every pound of new money created is a pound that someone somewhere owes to a bank. But don't worry, this process isn't as wild and unregulated as it might seem. Banks can't just create as much money as they want. There are rules and regulations in place to ensure that the system doesn't spiral out of control. So banks play a significant role in money creation, but how is this regulated? That's where central banks come in with their role in controlling money supply through monetary policy. You see, central banks are like the puppet masters of a nation's financial system. They pull the strings determining how much money is in circulation at any given time. This responsibility is crucial, as it directly impacts inflation, unemployment, and economic growth. One way central banks regulate money creation is through a concept known as the reserve requirement. This is a rule stating that banks must hold a certain percentage of their deposits in reserve. By adjusting this percentage, central banks can control how much money banks are able to lend out, and in turn, how much new money is created. Now, imagine you're a bank. If the reserve requirement is high, you have less money to lend, reducing the amount of money in circulation. Conversely, if the requirement is low, you have more money to lend, increasing the money supply. It's like a financial seesaw. Interest rates are another tool in the central bank's toolbox. By manipulating these rates, central banks can encourage or discourage borrowing and spending. If interest rates are low, borrowing is cheap and spending increases, leading to more money in circulation. If rates are high, borrowing becomes expensive, slowing spending and reducing the money supply. A third method central banks use to regulate money creation is through open market operations. This involves buying and selling government securities like bonds. When a central bank buys securities, it injects money into the economy, increasing the money supply. When it sells securities, it pulls money out of the economy, reducing the money supply. Through these tools and strategies, central banks can adjust the money supply to meet the economic needs of a country. They can stimulate growth during a downturn by increasing the money supply, or cool off an overheating economy by reducing it. Central banks have a crucial role in ensuring economic stability by controlling money creation. It's a delicate dance of balance and adjustment, but when done right, it keeps the economy ticking along smoothly. So why does all this matter, you might ask? Well, the process of money creation plays a pivotal role in our economy. It's like the beating heart that pumps life into the economic body. First, let's talk about inflation. When banks create too much money, prices can rise rapidly, leading to inflation. On the flip side, if they create too little, we might face deflation, where prices fall and economic activity can slow down. Balancing this act is crucial for a healthy economy. Next, employment. Money creation influences job markets too. When banks lend more, businesses can invest in new ventures, potentially creating more jobs. But if the banks tighten their belts, the opposite can happen. And what about economic growth? Yes, money creation plays a significant role here too. More money means more spending, and more spending can boost economic growth. But remember, it's a delicate balance. Too much can lead to inflation and financial instability. Speaking of financial instability, let's touch on the potential issues. If banks create too much money by lending irresponsibly, it might lead to financial crises. We've seen examples of this in the past, where unchecked money creation has led to economic downturns. Understanding how money is created gives you a better grasp of how the economy works. So next time you use your card or take out a loan, remember, you're part of this fascinating process. If you've enjoyed this video so far, please like and subscribe to our channel. What topics would you like to see more of on our YouTube channel? Share your suggestions in the comments below. Your support means the world to us. Until next time, take care.